Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today we're going to continue our conversation about whether or not we think Santa Claus is coming to Wall Street. And so we've been kind of breaking down for the past few weeks, typically what we could expect, and we talked last week about the fact that was the Grinch possibly going to come and steal Christmas with things like stimulus breaking down, and we continue to be overextended from our means. And so today we're just going to talk about the fact that is Santa Claus coming, what can we expect? And if we look back at historical numbers, we can say probably he's coming to town this year. And I say that because when you look back at historical figures, over 76% of the time, markets do experience a Santa Claus rally. They do experience strength moving in from the mid to end of December, moving into January. And so, one of the risks that we had discussed early on was the fact that in December, those first 2 weeks in December, we can see some weakness kind of happen as portfolios are being reallocated, as money managers are making distributions, as pension funds are kind of redistributing, reallocating. We can see kind of some sloppiness in the market. We say sometimes the market's frothy. And so I'm going to show you in a little bit that we did see the S&P 500 definitely slid sideways, traded sideways, didn't go a whole lot, was down for the first beginning of the month, first 2 weeks. So we'll show you that, but nothing too significant, nothing that I would have, nothing certainly that would be considered a correction. A correction is 10% or more. So just a very, very slight pullback. Really, again, just talking about just kind of going nowhere within the market. And so now moving in, though, to the end of the year, mutual funds are window dressing their portfolios, so they're taking a look at what's done very well, kind of reallocating, getting ready for the new year, hoping to be able to have another good year moving forward. And so we're kind of seeing some of those position changes being made now. And so we talk about Santa Claus rally historically. What do we typically see? And so here is a great example. So going back to 1985, just looking, this is actual trading days. So looking back from 1985 to 2019, historically, what's happened on different days. And so we're here, and so you can see we typically see a strong finish to the year, 76% of the time. But let's remember, though, those laws of averages, that every now and then we do get coal instead of a rally. Back in 2018, I'm going to flip over on this side, you can see when the market was down over 16% for the month of December. And so that caught investors off guard quite significantly. That was when the trade negotiations between the U.S. and China broke down for the first time. So you can see every now and then it's not a done deal, that sometimes the market is naughty and we get put on that naughty list and get coal. So I just wanted to make that determination that while, yes, 76% is a good number, it's not foolproof. Looking here, the market is still behaving very naughty. And so you know that really since we started these videos, we've talked about how detached we are from fundamentals, how detached we are from our longer term moving averages. We saw those corrections in September and October, which brought us down to a healthy level. And then, man, we just totally did away with any of that sell-off that we had seen that kind of brought us to a more healthy place. Went right back up in November after the election, and vaccine optimism just really kind of went through the roof. And so any bit of oversold that we had is done. And so the one thing I want to show you is, so here's kind of a candlestick of the S&P 500 since the beginning of December. You can see we've really just done a whole lot of nothing. We've kind of just traded sideways. When we had that last bit of a sell-off here, you can see we did hit a previous line of support. So that would be a previous high that we'd seen in the market, and we held that very nicely, bounced right off of that. So that's good, so that we can probably consider that a line of support for the market moving forward, at least for the short term. One thing I want to show you, though, talking about being deviated from our moving averages, I mean, this is significant. Small caps and mid caps right now are deviated 3 standard deviations. Again, they're non-sustainable for the long run. Right now, the market is completely overrun with a bullish sentiment. So the optimism, the exuberance that we have right now in the market, there's not a whole lot of rhyme or reason to it necessarily, except for being excited about things like vaccines and what that's going to do for the economy. Continuing to have optimism over the idea that we could get stimulus. We are just in a stimulus-driven frenzy in the market. And it'll be interesting to see if the government can even really substantiate the need for us to have a substantial stimulus package when you look at a lot of the other economic indicators kind of seem to be doing better. So that has the potential to disappoint markets if they don't get what they want regarding stimulus. That was a big part of what we saw in the spring about why that run-up kind of happened. So again, we are still behaving very naughty as investors. We are extremely greedy. The greed indexes are back to being off the charts. Put to call ratios, which basically means that as investors are making decisions, they're not putting any puts against the market. So nobody is saying, hey, I think the market's going to go down here, I'm going to actually bet against it. Everybody's all in saying that the market's going to go up. Greed's at an all-time level. We are completely deviated from our long-term averages. Really, at every point that you look at, we're deviated. We're completely deviated from fundamentals. All those things, they'll eventually come back to reconcile. But right now, we have this bullish sentiment that's just dragging the markets up higher. But those are things that we're looking at. And so that's why it's really important to make sure that you know where you're invested in the market and why. And let me show you here. So this is really how this works. So for first 2 weeks in December, so from December 1, the orange line here is going to be the S&P 500, and you can see, we started here, we did a whole lot of nothing, had a steady, pressure, downward price pressure has been on the market now for days. So since December 1st, S&P 500, now this is prior to today's action. Today markets had a very strong day across the board, so this will change tomorrow, but the S&P 500 was down for the month of December as of yesterday, 0.34% negative. This is one of our tactical models. So that over that exact same time frame, one of our tactical models was up 2.12%. So that's the idea. So when you have find those areas of relative strength that are positive momentum, really knowing where you're investing and why will definitely help you have better long-term outcomes. And so that's kind of the idea, avoiding the weak areas, being invested in the areas of strength. And what I'd really like to do now is kind of actually show you how this works. And so there are thousands of funds that you can invest in. There's thousands of funds that we can use to make up our portfolios. So how do we make those decisions on what funds kind of make the cut, why we're allocated to them, how much of a percentage of allocation do they get? And so this is how this works. So we use something called dynamic asset level investing, which essentially ranks, and I'm actually going to move over here so I can show you this full screen here. It ranks all the different areas of the market and the different asset classes. So it's almost like, if you can imagine, every day, every fund in the market arm wrestles each other. And at the end of the day, there's winners and there's losers. And what Dolly is able to do is it ranks those winners. And as more and more trading days go on, you begin to see patterns. These are typically the winners and these are typically the losers. And every day we get more and more data to substantiate it. And so we say that if you were going to be choosing on your fantasy basketball team who you were going to be putting on your team, or which teams you think are going to make it to the playoffs, you would want to be looking at records. And at the beginning of the season, you might not know exactly where it's going to fall, but as the season continues to play out, you can identify these teams are strong and these teams are weak. And it's not necessarily typically by chance on who wins and who loses. You can begin to identify. So Dolly does the same thing for us. So you can see here within our broad bases, domestic equities is far and away the best place to be investing in right now, followed by international. So this is a really interesting move, actually. International for a long time was way at the bottom of Dolly, and it has just been leapfrogging over all these areas pretty consistently over the last month and a half, 2 months. It just became second just about 2 weeks ago, and so we've been watching these moves very carefully as it's been gaining strength, with the idea that we may actually take some positions in international now that it's become second in Dolly, because it's showing positive relative strength, but it is still in second place, so that's something that we would consider. And so within domestic equities, mid-cap, small-cap, large-cap growth would be the three broad-based areas that were strongest for now, and then for the sectors, technology and consumer cyclical. And so what's interesting too, these are interesting moves. Large cap growth prior to about a month ago had been far and away number one, and then small cap and mid cap had been lagging pretty dramatically. And what we've seen is as the market breadth has begun to get a little wider and a little more all-encompassing, we've seen small cap and mid cap really start to play catch up here. So it's not so much that large cap is showing significant weakness, it's just that these other two areas are getting more buy signals. It's more and more are doing better, and so it's just it gives them some strength here. So that's kind of how this works. So let's just say that as an investment manager, I want to, all right, mid-cap growth in domestic equities is number one. I'm going to choose a mid-cap fund. And so I want to show you here how this kind of, how this works over the long run with using relative strength. And so I just so happen to know the fund that we use. And so what this is doing, it's ranking them based upon their score. Okay, so we want to look at relative strength scores. 6 is the best, and so we want to find areas that have strong relative strength versus the market. And now some of these areas here, we ignore some of them because even though they're mid-cap fund, they're very, very maybe narrowly focused, and a lot of times that might not be what we're looking for. But so here's our mid-cap fund right here. So really quick, I just want to kind of show you, so these are some of the things that we're looking at within our funds every day. So number one, 5.41 is the current score. It's a very strong score. You see the arrow up, it's going up. So not only is that relative strength strong, but it's positive, it's moving up. Against the average mid-cap score of 3.96. So right off the bat, we know this fund is pretty special. So this fund has a score that is significantly higher than the other mid-caps in its class. So we're okay. That's a check for the yes box for us. Something else, so it's in a positive trend. It's on a buy signal. It's in a column of X's, which just means that the price action is going up and rising. And this here, weekly overbought, oversold, 36%. So the lower the number, the less overbought it is. As this number approaches 100, it tells us that might be a little overbought, overvalued, at least for the short term. We typically won't make any, we won't sell because it becomes overbought, but we might consider not taking new positions until that number was healthy. This is a very healthy number. And then here, this is just the chart that we are just constantly looking at to make sure that our price action is rising, not falling, and that we're following, this is our trend line here, that we want to be going up that way. And so that shows us that our mid-cap fund right now is doing very well. And so you can see that when we look at performance, and when we look at things like this, that's how we're able to have a return of 2% over the same time period that the S&P was only up, or was down negative 0.34. Finding those areas of the market that have positive relative strength, because you already saw back here that there were many different mid-caps to choose from. And these are just some of the ones that were picked out as being ideas to consider. So there's hundreds. So that's how we have the ability to kind of go in and say, okay, where should we be allocating? Where should we be steering away from? Because eventually it's possible that that fund's score is going to begin to drop. Or maybe we decide that one of the areas that we're in, I'm just going to really quick, I wasn't going to do this, but I think it actually might be helpful. So technology is a sector area. So this is an area that we watch very carefully. This is what allows us to have those so-called, pops in the market. But at the same time, as they grow out of favor, we need to make sure that we're following that, because eventually what's in favor can likely become out of favor. And let me see. Of course, you know what? We'll do it this way. This was not planned, but I just want to kind of show you, since I already started mentioning it. Okay. So this is one of our sector funds here, and so the idea here is that we have a score of 5.88 versus a sector score of 4.7. So what does that tell us? That tells us this is a very, very strong fund within the sector. We can see that compared to all U.S. equities, 3.88, 5.88. So it's really outranking all equity funds. But the idea here, now here our overbought, oversold is 66%. But again, in a very positive trend line, a very positive price action. But when that score begins to kind of dip off and we begin to see weakening within a sector, within an area of the market, that gets our attention that, hey, maybe that area is moving out of favor. And then what we do is that rather than rebalance, we just take it out of the portfolio and replace with something else that has a high score. And so that's kind of the idea. That's how we are able to make keep up with those rotations as they happen. And the beautiful part about the process that we follow is that it eliminates a lot of the noise so that we're able to just kind of follow that momentum and relative strength. So I hope that was helpful for you today. Just really wanted to be able to kind of show you, number one, the importance of making sure that you know where you're allocated and why, so that no matter what, if Santa comes and brings us a rally or the Grinch comes and brings us coal, we at least know that we've set ourselves up to have the best possible outcome. And so I thank you for joining us. I look forward to speaking with you next week. Stay safe, and we will see you then.